A base salary is the most visible part of a paycheck, but executive compensation frequently embeds housing, equity, and private medical coverage directly into the contract. To the tax code, these separate streams flow into the same reservoir of taxable salary. Legally, these non-cash additions are classified as perquisites. A perquisite is any casual emolument or non-cash benefit attached to an office or position, provided to an employee on top of their standard salary. Without strict statutory rules, a corporation could pay an executive a minimal cash salary while providing a luxury mansion and a fleet of cars to avoid income tax. Section 17 is drafted to shut down that strategy. To understand how the code processes these benefits, we use a three-pillar taxability matrix. Pillar 1 defines the inclusions, Pillar 2 carves out the exemptions, and Pillar 3 provides the mathematical valuation rules. The underlying logic is simple. If an employer hands you a non-cash asset or pays a personal debt on your behalf, the tax code treats it exactly as if they handed you the equivalent in cash. We start with Pillar 1, Section 17(1). This inclusions net is drafted broadly to catch every form of economic enrichment. The first slots fill with housing. If an employer provides rent-free accommodation or charges a rate below market rent, that value is taxable. The net also automatically captures free or discounted amenities provided to company directors, employees holding substantial interest, or those exceeding statutory salary thresholds. Stock options and sweat equity shares allotted at a discount are also locked in as taxable perquisites. If an employee owes a personal debt and the employer pays that sum directly, that discharged obligation is captured. Employer payments for life assurance or annuities are also taxable, though the statute provides specific carve-outs for recognized provident funds. Those retirement carve-outs, however, are not unlimited. High-earning executives previously routed massive amounts of tax-free wealth into these funds. Now, Section 17 imposes a strict ceiling. As you can see in the statutory text, if the aggregate employer contribution to a recognized provident fund, a Section 124(1) scheme, and an approved superannuation fund exceeds 7,50,000 rupees in a single tax year, every rupee above that limit becomes a taxable perquisite. Clause I takes this one step further. Any annual interest or dividend directly generated by that excess contribution is also taxed as a perquisite. By capturing everything from housing to excess retirement interest, Section 17(1) guarantees that wealth transfers between employer and employee remain fully visible to tax authorities. The tax code must differentiate between luxury perks and basic human welfare, bringing us to Pillar 2, the exemptions. For domestic health care, any medical treatment provided to an employee in a hospital maintained by the employer, government, or local authority is completely tax-exempt. Treatment for prescribed diseases in hospitals approved by the Principal Chief Commissioner is also protected. Furthermore, if the employer pays health insurance premiums under schemes approved by the central government or IRDAI, those payments are entirely exempt. On the operational side, employer expenditure for a vehicle used strictly for commuting between the employee's residence and their place of work is excluded. Healthcare becomes more complicated when the required treatment involves crossing international borders. Under Section 17(2)(f), the law outlines three distinct exemptions for foreign medical care: the cost of the medical treatment itself, the cost of travel and stay for the patient, and the travel and stay for exactly one attendant accompanying them. Pillar 2 acts as an empathetic filter. It ensures employees do not face tax liabilities simply because they suffered a medical emergency or relied on company transport to do their jobs. However, to prevent luxury foreign holidays from being disguised as tax-exempt medical trips, Section 17(3) applies strict condition gates. First, expenditures for foreign medical treatment and stay are only exempt up to the specific monetary limit permitted by the Reserve Bank of India. Second, the cost of foreign travel is governed by a completely different metric, the employee's gross total income, or GTI. If this income exceeds a prescribed statutory amount, the travel exemption is entirely voided, and the full cost of travel becomes taxable. The code offers medical mercy, but applies rigorous financial ceilings based on national macroeconomic policy and the individual wealth of the taxpayer. Finally, we reach Pillar 3, valuation. Abstract rights, like stock options, have to be mathematically converted into hard monetary figures to be taxed. Looking at the statute for sweat equity and specified securities, The law provides a specific mechanism for determining this value. The taxable value is the fair market value of the security, minus any amount the employee actually paid to acquire it. The tax liability isn't fixed at the grant or vesting date. The fair market value is locked to the specific moment the employee exercises the option. By definition, an option gives an employee the right, but not the obligation, to purchase these securities at a predetermined price. And sweat equity shares refer to equity issued to employees at a discount or for consideration other than cash, as a reward for providing know-how or intellectual property. Pillar 3 eliminates subjectivity, taking the abstract concepts of corporate rewards and translating them into precise mathematical tax liabilities. When we step back, the complete taxability matrix reveals a tightly engineered system. Within it, 3 specific mechanisms consistently demand attention during audits. Pillar 1 casts an inescapable net over non-cash benefits. Pillars 2 and 3 act as scalpels, carving out genuine human necessities while carefully measuring everything that remains. For retirement contributions, the 7,500,000 rupee aggregate limit triggers taxation not just on the principal, but on the proportional interest it generates. Equity valuations remain tethered exclusively to the fair market value on the exercise date, regardless of when the shares were first offered. Foreign medical audits require a dual check. The RBI limits govern treatment and stay, while the employee's gross total income determines whether travel costs are exempt or fully taxable. Section 17 operates as a strict computational engine. It ensures that whenever economic value transfers from an employer to an employee, total tax accountability follows.